Hello, my name is Doug Greenberg, founder and president of Pacific Northwest Advisory. Thank you for viewing this monthly video series. Fund manager sentiment has worsened, with 65% foreseeing a weaker economy, according to a BofA survey. Despite two-thirds of investors predicting a soft economic landing and minimal earnings contraction, the global stocks rally has paused due to concerns over persistent inflation and the effects of prolonged higher interest rates. Uncertainties around the U.S. debt ceiling negotiations also have suppressed risk appetite, with 71% expecting a resolution by the X date. Weak economic data, particularly from Germany's faltering manufacturing sector, also further dampens investor confidence. Investors are exiting commodities and utilities for tech stocks and Eurozone equities, with the most crowded trades being short US banks and the US dollar, and long positions in tech, European, and China equities. Top tail risks include a bank credit crunch, global recession, hawkish central banks due to high inflation, geopolitical worsening, and a systemic credit event. While prices are starting to move lower, about a 1.7% year-over-year decline is the largest since 2012, it's not nearly enough to make a difference. Supply remains constrained as many would-be sellers simply can't afford to move. Two-thirds of mortgages have an interest rate below 4% versus a 6.4% rate today. And most of the buyers from the last few years could not afford the house they're living in if they had to buy them at current rates and prices. The result? A standstill in the housing market with existing home sales down 23% year over year, the 20th consecutive year over year decline. That's the longest down streak since 2007 and 9. Credit card delinquencies have hit a all-time high since 2010, with a sharp 45% rise in the number of delinquent accounts over the last year, and a 5% increase compared to the end of 2019. Smaller, riskier accounts are showing early signs of distress, while delinquent balances, which typically lag, have escalated by more than 60% this last year and are still on the rise. Despite efforts to rein in risky accounts, reducing risk in larger, seemingly more creditworthy accounts remains challenging, further complicating the situation for lenders. As economic growth is anticipated to slow in 2023, delinquent balances are projected to increase, urging lenders to maintain caution and vigilance. In the bottom chart, we review corporate bankruptcy filings within the financial sector, which have surged in 2023, marking the highest level since 2010 within the first 2.5 months of the year. Notably, SVB Financial Group's Chapter 11 filing on March 17th was the ninth in the sector. The rise in bankruptcies, primarily Chapter 11 for reorganization, has been driven by increased borrowing costs due to soaring interest rates and persistently high inflation, which is a significant shift from the low numbers observed in recent years when interest rates were much lower. In April of 2023, the Conference Board's leading economic index, LEI, for the US fell by 0.6% to 107.5, signaling a deteriorating economic outlook. This marked its 13th consecutive monthly decline, culminating in a 4.4% decrease over the last 6 months. Overall, the persistent decline in the LEI suggests impending weak GDP growth and the potential for a mild recession by mid-2023. The Conference Board forecasts a contraction of economic activity starting in Q2, leading to a mild recession by mid-2023. The LEI is highly correlated with real GDP. The LEI is a predictive variable that anticipates or leads turning points in the business cycle by around 7 months. The US is in the late stages of its economic expansion, with a growing probability of a recession in the mid to later half of 2023. Key sectors such as housing, manufacturing, and credit are displaying warning signs of a growth slowdown despite resilient lagging indicators like the unemployment rate. While inflation has noticeably decelerated thanks to declining commodity prices and ease in manufacturing supply pressures, a stubbornly high inflation in certain categories due to a tight labor market suggests that core inflation may persist at higher levels than we've seen in recent years. In my opinion, at this point in the business cycle, it makes the most sense to reduce risk in your portfolio, whether that be owning stocks that have lower valuations or lower PE ratios, or reducing the risk of your bond portfolio, or simply adjusting your asset allocation. In this phase of the business cycle, our primary aim is to safeguard capital. By doing so, we'll have more resources at our disposal when the economy bounces back. Thank you again for viewing. If you have any questions, please email using the link above.